Navistar International's International Truck and Engine Corporation manufactures large trucks and diesel engines. It is a multi-billion-dollar Fortune 300 company with over 40 major locations, most in the United States. One of the international truck product lines reported 1 month's production cost to be approximately $7 million over budget. The planned production costs, based on standard cost estimates, were $41 million per month. The actual cost was $48 million. The $7 million unfavorable variance, at first glance, seems like bad news. Upon further analysis, however, a real savings of $4.5 million was the bottom line. A closer look at how budget cost standards, actual costs, and variances were used in the calculation will help clarify the savings analysis. Budgets not only set standards to control and evaluate managerial performance, they can also be used as aggregate measures of performance, identifying the revenues and costs in total that an organization should experience if plans are executed as expected. What happens if plans are not executed as expected? In the truck assembly plant, plans were not executed as expected. This month's budget of $41 million was based on the forecasted production standard of 883 trucks in 22 days. Actual production was 1,129 trucks in 19 days. Actual production shows a significant variance from the standard volume in the budget. What does that say for the accuracy or usefulness of the standard? A brief explanation of how and why standards are developed will answer this question. Unit standard cost is determined by multiplying quantity standards times price standards. Quantity standards are set by determining the level of input needed per unit of output. Price standards are set by determining the amount that should be paid for the quantity of input to be used. At International's truck assembly plant, the production standard cost was set at $41 million for 883 trucks. The unit standard cost is approximately $46,000 per vehicle. How are these production standard costs and unit standard costs developed? Historical experience is one of the initial guidelines for how these standards are set. Engineering standards are also factored into the equation to help set these guidelines. Another source of experience for setting these standards is the input of operating personnel. Price standards are the joint responsibility of operations, purchasing, personnel, and accounting. Using participative budgeting principles, they combine historical experience, engineering standards, and experienced operating personnel to compute the standards. Standards are classified as either ideal or currently attainable. Ideal standards require maximum efficiency to achieve. Currently attainable standards can be achieved under efficient operating conditions. At International's truck assembly plant, the standard cost of production, $41 million this month for 883 trucks, is a currently attainable standard. We'll see why that is so in a minute. In a standard costing system, costs are assigned to products using quantity and price standards for all three manufacturing costs: direct materials, direct labor, and overhead. The International plant uses the standard costing system to compare actual costs to standard cost. The advantage of using standard costing systems is that they provide readily available unit cost information that allows for better production control as well as pricing control. It makes measuring variance of actual from standard quick, accurate, and easy. To understand why a total production cost of $48 million at International really represents a $4.5 million savings rather than a $7 million deficit, it helps to first understand the concept and process of variance analysis. Total budget variance is the difference between the actual cost of the input and its planned cost. Unfavorable variances occur whenever the actual prices or actual usages of inputs are greater than the standard prices or standard usage. Favorable variances occur when the opposite is the case. The actuals are lower than the standard. At the International Truck Assembly Plant, the variance seems unfavorable by $7 million. However, one of the advantages of standard costing is that it provides information to control production costs. Decisions can be made more quickly and more accurately if the standards are used. In this case, use of the standards gives insight into the real savings. The standard cost per truck is approximately $46,000 using the currently attainable standard. However, in the given month we are investigating, more trucks were produced, 1,129 versus 883, in fewer days, 19 versus 22. Remember when we asked what happens when plans are not executed as expected? This is one of those times. 1,129 trucks per month is a favorable variance of 246 over the standard of 883. 19 days of production is a favorable variance of 3 days over the standard of 22 days of production. $48 million in production cost is an unfavorable variance from the monthly standard of $41 million. Variance analysis on these three variances is possible since we have standards. We see that 1,129 trucks produced in 19 days at a cost of $48 million shows an average actual cost of $42,515 per vehicle. That is a favorable variance of $3,917 per vehicle, approximately a 9% savings. So, rather than being a $7 million unfavorable variance, it is actually a $4.5 million savings. Using the standard costing system provides the tool to quickly and accurately reach this conclusion, and it enables managers to make quick and accurate production decisions. Does this 9% variance warrant changing the currently attainable standard upward? Or is this 9% variance possibly an ideal standard, indicating that production was at peak efficiency for this particular month? To answer either of these questions, an investigation into what created the production efficiencies would be in order. It would be necessary to determine what costs per unit went down, what costs per unit stayed constant, and what costs per unit increased. By reviewing the variance analysis for each of these three manufacturing cost categories, direct materials, direct labor, and overhead, the correct answers can be found and corrective action taken. How did International's production of more vehicles in fewer days affect direct material cost per unit, direct labor cost per unit, overhead cost per unit? Where did it increase cost? Where did it decrease cost? This level of variance analysis can be done to increase control over production decisions, cost decisions, and pricing decisions. This level of variance analysis can be performed because of a standard costing system. This level of variance analysis enabled accountants at International Truck Assembly to make management decisions that saved $4.5 million in production costs and produced 246 more vehicles for sale in this one particular month.